All right, very good. So welcome everyone, and thank you for spending a portion of your day with me. I'm going to try to make this as valuable for you as possible. I think trading is one of the most exciting things you can do. If you have any desire or have ever had any desire to be a small business owner or have some sort of income that either replaces your current income or adds to what you have, trading is one of those things that can be a mystery for many, but it is certainly an opportunity for those who really apply the discipline. So what I'm going to show you today is a way that you can get started. Maybe you're a new trader, maybe you haven't really traded much at all, or you're a trader who has traded, has some experience, done a lot of things, dabbled in this, dabbled in that, but never really committed yourself to it. Or you may want to just kind of wipe your slate clean, you want to start over. I want to talk to you about what really is the art of trading, how to simplify your trading and grow bigger profits. So my trading experience, I'm going to make this very, very quick. I've been trading for over 30 years. 20 years of it was as a hobby, as Renee mentioned. I've been teaching for the last 10 years. I've taught thousands of traders, and I don't say that lightly. I've literally taught thousands of traders, used to teach live seminars, would have as many as 500, 550 people in a single seminar. I really value the art of education. My parents were both educators. My father was a college professor. My mother taught school. And so I grew up in a family that really prioritized, if you have knowledge that you can share with others, that others are seeking, do everything you can to share it with them. So when I retired from a 20-year career, 26-year career as an executive with a Fortune 500 company. I'd been trading as a hobby, really enjoyed it, was pretty good at it, I felt. So I had a lot of people asking me more and more, and I decided to teach. I host a live trading room every day. I'm a very active trader. I don't just teach and coach people. I'm actually active in the markets every day. Had a really great day today in our live trading room. So we teach new traders, we teach experienced traders, we teach active traders, and we teach casual traders, all the art of trading, how to think like a trader. So there are certain key success factors to winning consistently at trading. The two I'm going to focus on today are that are highlighted with the red arrows, which are basically what entry signal will you look for today and what strategy are you going to use to take advantage of an entry signal. A lot of traders come to the market each day not really prepared, not really focused on a plan. They are focused primarily on nothing. They are going to look and wait and see what the market does, and hopefully they can find an opportunity to take advantage of a certain signal. They might have attended some seminars, they might have read a book, they might have heard about the signal, they want to try to play around with that, but they're never really skilled enough to take advantage fully of a signal. And whether you adopt my signals and my strategies and the things that we teach or not really isn't important. What is important is that you know each day before the market opens what your daily trading plan is. You want to know what your total risk tolerance is. You want to know how much capital you're willing to have in your trading account and how much of that you are willing to put at risk. And then on any given day, you need to understand for yourself, this is a personal decision, how much you're willing to allocate to that day's trading. And if you come to your trading prepared with that information, you know how much your total risk is, you know how much you're willing to allocate into today's trading, it's going to alleviate a lot of the stress and fear that a lot of traders have, because they tend to make impromptu, rapid-fire decisions when they think they see an opportunity, and all of a sudden fear kicks in that they're going to miss out on the opportunity. And it is those types of decisions without planning, a lack of planning, that starts to get yourself into trouble, and you overcommit your funds and you incur greater degrees of risk than you really should for your comfort level. So managing your risk is very important, but that starts before the market opens. And then what's your profit target for the day? Now, a lot of people will just say that's kind of ridiculous to have a specific profit target because I can't plan for that. Well, as you start to become familiar and actually intimately familiar with a particular strategy and your signals, you will start to have a sense for what your profits can be for the course of a day, course of a week, or whatever. And one of the reasons I do ask people to focus on what their profit target for the day is because you are going to have losing days and you're going to have losing weeks. There's nothing wrong with that. In fact, it's just a natural part of trading. But if you have a losing day and you're a little frustrated and it's discouraging, you feel a little down, if you look back and you know that over the last 3 months, 6 months or so, you have X amount of gains, then you know whether or not you are actually on track or on pace to hit an overall goal that you may have for your trading. So that's a really important part. And then that leads us to what entry signal you're going to look for and what strategy you're going to use to take advantage of that entry signal. So I'm going to talk about that today. So a key success factor to winning consistently is really trade a strategy that you understand. There are so many different strategies available out there for options trading. For options trading, you can trade a variety of things, and you can trade a variety of instruments. And I believe that if you keep it just as simple as possible, you're going to be much more successful. So trade a strategy that you intimately understand, and if you don't understand it, then find a way to learn. Either read a book, attend a seminar, buy a program, hire a coach, but commit yourself to actually learning. Otherwise, all you're doing is dabbling. And in dabbling, you're going to take a little money, you're going to give a little money, and you're never really going to make progress. But keep it simple. You want a simple strategy because that's generally going to keep you in a more profitable side of the equation. And then you want to use simple entry signals when learning, especially so that you can develop consistent profits. Your first and foremost objective when you're really learning how to trade options, or when you're pressing the reset button and say, I just want to set aside everything that I've done, I want to start from scratch and I want to learn again, is trade to learn first and then trade to earn. Everybody seems to want to jump into options trading and earn a big amount of money right out of the gate, and that's possible, but you don't really know anything. And so if you focus on trade to learn first and then trade to earn, you're generally more likely to be successful overall with your trading, because what you're really building is a future for yourself, not an immediate gratification. Build a future where you build your profits and knowledge for the future. So you're going to choose a flexible strategy. You're going to choose one that actually will allow you to trade both directional bias signals as well as neutral markets. We're going to use simple entry signals, which I mentioned, and we're going to keep our trading limited to just a handful of instruments. Now, at Options Moneymaker, we like to trade 3 to 5 instruments. 3 of those are always going to be the 3 indexes: SPX, which is the S&P 500, RUT, which is the Russell 2000, and NDX, which is the NASDAQ 100. Those are not the ETFs, SPY, IWM, and the Qs. Those are options on the indexes. We have a lot of reasons, which I don't have time to get into today, that we prefer the indexes over ETFs, but they work very well for us. Today, for example, I did 6 trades on RUT, and that's all I focused on today, and had a very, very good trading day. But then we also trade a few stocks. Priceline, ISRG are 2 of the stocks that we like to trade. But the concept here is to keep your trading limited to 3 to 5 instruments so that you become intimately familiar with them. You know what those patterns are like. You know how they respond to market moves. You know how you can harvest profits out of those. That's going to keep your trading more simple, and it's going to keep it more profitable. And then at Options Moneymaker also, we teach and preach actually that set yourself a 10% profit target. We're not trying to swing for the fences here and hit home runs on every one of our trades. We're also not a big believer in the adage of let your profits run, because there are so many opportunities to take profits in that run where the position will run, take a profit, and it will retreat, and then it will run some more. And you'll actually have multiple opportunities to get into a trend. Base hits basically are a way you're going to win the game. And it also limits your risk on a pullback. So we set a 10% profit target generally, 10% of the capital that we have at risk in the trade. And then we turn around and we recycle the capital for bigger account growth. This is all about keeping it just as simple as possible and developing more consistent profits. So the strategy that we focus on, especially when we're working with newer traders or traders who want a fairly simple approach, is credit spreads. Now, credit spreads are a very widely traded, commonly understood strategy. It's a very simple directional strategy. It's simple, but unfortunately a lot of traders fail trading credit spreads. And there are three basic reasons they fail. One is they don't really know how to properly select strikes. It's rather arbitrary for them. Two is they don't build sufficient time into the position, and time is our friend. You always need to remember that time is your friend. And if you trade expirations that are too close to today, it may feel like that's a good opportunity to benefit from the time value decay that occurs in options, but it can present some other challenges for you if the price moves against your position. And we're going to talk a little bit more about that. And then the third reason is that they put on too much risk and they really have a poor understanding of what proper risk management was all about. Now, these three reasons are derived from many conversations I've had with people who I've personally coached, people who I've met in a lot of the seminars that I used to teach, and in the webinars that I teach today. These are the types of things that I hear from people. If I had done this, if I hadn't done that, I would have been much more successful. And I really want to try to help traders not just be successful, but try to avoid the pitfalls of trading and some of the challenges that exist that knock people out of the game. I want to see everybody stay in the game. I want to see you win. So there are three steps to entering a trade when we're talking about opening a credit spread. Number one is you've got to use a chart. Now, if you're already very comfortable with the chart that you use, you may want to stick with that. I'm not saying that what I'm teaching and sharing with you today should replace what you're doing. If you're very comfortable, and I mean intimately comfortable with the chart patterns that you're using and you understand the signals, then you may want to stick with that. If you don't know where to begin because charting seems overwhelming to you, if you don't really understand what charting is all about, then I have a starting point for you, and it's basically working with Bollinger Bands, and I'm going to show you a chart here in just a minute to explain that. But the second step then is going to your options chain and choosing the strikes that are choosing the expiration of the position that you're going to trade, the credit spread position that you're going to open. And generally, as a rule of thumb, the sweet spot for trading credit spreads is to be out 2 to 4 expiration periods, 2 to 4 weeks, basically, when you're trading these indexes that we like to trade. And a good measurement of whether or not you're properly placing your strikes for a reasonable amount of risk and opportunity is your credit spread, your 5-point credit spread, and I'll give you an example here in just a minute, but it should have a credit of between $1.20 and $1.80. That's going to get you into the sweet spot that's going to increase the likelihood that you're going to be successful in the trade where you're not so close to the price that you run the risk of perhaps having a loss, but you're also not so far out of the money that if you actually did end up with the price intruding on your position, you have an unmanageable position because you've got such a small starting credit. Size of the position should always be based on your personal account size and your personal risk tolerance. Never, ever overextend the risk. So here's a very simple chart of Intuitive Surgical, ISRG. This shows basically the bars, which is the price, and the blue bars, if you've never seen this before, the blue bands on the outside of the price are the Bollinger Bands. There are two sets of blue bands. The inner set is the upper and lower 2 standard deviation Bollinger Band, and the outer set is the upper and lower 3 standard deviation Bollinger Band. And one of the reasons that we start newer traders especially, or traders who have some experience but aren't comfortable with their charting, one of the reasons we start them with Bollinger Bands is because we know that based on historical experience, that when the price moves to the upper Bollinger Band, there's an increased likelihood that there's going to be some movement, most likely back down towards the lower Bollinger Band. When the price moves to the lower Bollinger Band, there's an increased probability that the price is going to move back up to the upper Bollinger Band. Now, folks, this is a very, very simple approach, very simple way to use this Bollinger Band approach and be able to identify when a good directional bias trade could be placed. Now, there's something we also at Options Moneymaker refer to as the Bollinger Band snap pattern. And it is basically when you have a price that has moved outside the upper or lower Bollinger Band, it increases the likelihood at that point that you're going to have a snap back inside the Bollinger Band envelope, that area between the upper and lowers. So you can see here as an example, this was an extreme Bollinger Band snap where the price moved well above the 3 standard deviation Bollinger Band and then snapped right back down, and you can see it then moved all the way down to the lower Bollinger Bands. So this is the patterns. This is the pattern that we use, especially for newer traders, and we profess keeping things just as simple as possible. And that is a way for you to keep your charting very simple as you're just starting out. Now here's an example of a credit spread trade, just to make sure that we're all on the same page of what a credit spread is. SPX, the S&P 500, was trading at 2360 during April week 1, and we saw a declining bias on the chart, evidenced by the Bollinger Bands and other simple technical indicators that we use. So what we did to take advantage of this is we sold to open April week 4 2400 call and bought to open April week 4 2405 call. So that creates the spread. There's a 5-point difference between the strikes. So the maximum risk we have on this trade is the difference between the strikes, which in this case would be 5 points. April week 1 is when we were opening this. We went out 3 weeks, and typically we go out 2 to 4 weeks. That's kind of our comfort zone for expiration. Now there's also a thing called the forgiveness factor here, where the index was trading at 2360 and we sold to open the 2400. Now, when you trade a credit spread, this is a declining bias credit spread because it's a call credit spread. We want the price of the index to remain below 2400. If it does, then we have a profitable trade. But even if the price were to move higher but stay below 2400, we still have a profitable trade. So there's this zone between where the price was at the time we opened the trade and our risk strike, the strike that you sell to open, that's what we refer to as the forgiveness factor. So in this case, we had a 40-point forgiveness factor. That means that the index can actually move 40 points higher, even though we think that there's a declining bias, and we could still have a profitable trade. So the forgiveness factor is a natural factor that's built in when we look for $1.20 to $1.80 of credit on our position. So we went outside the Bollinger Bands, we took $1.20 of credit on our position, and those factors combined give us a highly probable degree, a high degree of success, probable success on this trade. No guarantees, but we're trying to stack the deck in our favor and give ourselves a high degree of likelihood that we're going to have a profitable trade. And then we're 3 weeks out to expiration. So the rules that we follow are use the Bollinger Bands to set up our trade, open a 5-point spread, 5-point difference between the strikes, take $1.20 to $1.80 of credit on the trade, and be 2 to 4 weeks out in terms of expiration. Now, in terms of absolute risk, 5 points is the gross risk, but since we're taking a credit of $1.20, we actually have $3.80 of net risk. And it's the $3.80 of net risk that we would use to decide the number of contracts that we want to trade. And we would only trade the number of contracts that would be comfortable for our account. Once we've opened this, we're going to place a good till canceled order, a GTC order, good till canceled, to close the position for a 50-cent profit. 50-cent profit. That is a 10% profit based on the gross risk of $5. It's actually more profit, a greater percentage profit on the net risk, but we measure this conservatively based on the gross risk of $5. I'm not interested in trying to hold this trade for 3 weeks and keep all of the $1.20 of credit for profit. I'd rather take my 50-cent profit, which is 10% of the gross risk, and then find another opportunity to put this capital into another new trade. So this trade's set to benefit from a move down, but it's also got that 40-point forgiveness factor, where if SPX moves up instead, we could still potentially have a profit on this trade. So this is not complicated to set up these credit spreads. Credit spread can be entered based on a Bollinger Bands, and you want your strikes, you want your risk strike as much as possible to be outside the Bollinger Band. In this case, it would have been outside the upper Bollinger Band, because we know that when the price moves up to that Bollinger Band, there's an increased probability that it's going to reverse and move lower. No guarantees of that. Sometimes it keeps moving, but that's an increased probability. So we have outside the Bollinger Bands our risk strike. We have the 40-point forgiveness factor. We have $1.20 of credit, which fits into our model of $1.20 to $1.80, and we've got a reasonable amount of risk on the trade. Now, the cool thing about credit spreads is they're directional bias positions, but they can also be set up and used as a non-directional position. And when we construct both a call credit spread and a put credit spread at the same time on the same index, using the same expiration, then we have what's called an iron condor. And it just makes the credit spread so much more flexible, because what we have to do is really learn everything we possibly can about how a credit spread performs. And by staying with that one underlying foundation and understanding of a credit spread, we can now construct a non-directional position. So we open both a call and a put credit spread at the same time. We're still going to use the Bollinger Bands. That's the same rule that we already learned. We're going to use the Bollinger Bands as a guide to choose our strikes. Ideally, we would want our call risk strike to be outside the upper Bollinger Bands, and ideally we would want our put risk strike to be outside the lower Bollinger Bands. And if that is not possible to get outside those Bollinger Bands on both sides and still have $1.20 to $1.80 of credit on each side, then you get as close to the Bollinger Bands as possible. When we set up a iron condor, we are going to have a potential profit regardless of which direction the price moves. One side will always win on whatever movement occurs, and the other side is going to benefit from the forgiveness factor, where the movement can occur moving towards the other side, but as long as it doesn't go through the risk strike, we still will potentially have a profit. And one of the things about trading these iron condors, and particularly trading them on the indexes, is we know with 100% absolute certainty that the price of the index cycles. Anybody who tells you that the index has just been in a nonstop move to the upside or a nonstop move to the downside is just wrong. They are not looking at the detail. They're not looking at the intraday and the every 1, 2, or 3 day movements that occur where the price moves higher and the price moves lower. Your opportunity to really harvest profits and learn the art of trading is to understand how to take advantage of those cycles. So here's an example of an iron condor on RUT. We actually just opened this one this week. So it was during May, week 3. We're in the third expiration week of May, and the price of RUT was trading at $13.59. And what we decided was to take advantage of an uncertainty we saw of whether RUT would move higher or RUT would move lower, and we decided to open an iron condor. We sold to open the 1380 and bought to open the 1385 call. So 1380 is our risk strike on the call side. We want the price to remain below 1380. And on the put side, we sold to open the 1345 put, and bought to open the 1340. So we have a 5-point spread difference between our strikes. And the other cool thing about iron condors is you don't count the 5 points on each side. You don't count it twice. This iron condor has 5 points of gross risk because you cannot possibly have a losing situation on both sides of your iron condor at the same time. You could find yourself trading above 1380 or below 1345, but that cannot occur at the same time. So you only have 5 points of risk on gross risk on an iron condor, and we took $2.72 of total credit, $1.44 on the calls, $1.28 on the puts. So both of those fit into our sweet spot of $1.20 to $1.80. We have, this was a little close to expiration. We went out about a week and a half on this. Generally, we go 2 to 4 weeks out, but this was about a week and a half out to expiration. And so we have $2.72 of credit. And when we look at our 5 points of gross spread risk minus the $2.72 of credit, this trade only has $2.28 of actual net risk. So the iron condor allows us to take a greater amount of credit against the same amount of risk. Now, the other thing about iron condors is that they present an opportunity, and the thing I want to emphasize here, folks, is I'm still staying with the same credit spread theme. But what you do is you build the foundation, understanding, have an intimate knowledge of one particular strategy, and then you learn the ways that you can vary that strategy into directional, non-directional, and expanded profit opportunities. So when you have an iron condor in play, there are ways that you can actually harvest profits from that iron condor in order to actually increase the overall profit potential for your account. So adjusting an iron condor for bigger profits is what we refer to as an SICP. It's a seed iron condor for profit strategy. Iron condors are an excellent seed position. So we open the position. We don't have a strong bias in either direction, so we're going to open this position because we know that we're the following day, because we don't day trade in these positions, but the following day we're going to be able to harvest profits off of our iron condor. Almost guaranteed that the following day you're going to be able to harvest profits. So a day after opening the iron condor, we're going to harvest profits from one of the 4 legs of our iron condor. We're going to harvest profits by widening the spread. We're going to widen from a 5-point spread to a 10-point spread. What that does is it grabs a profit and it still leaves the position open for additional potential profits. I'm going to show you an example of how we did that on that iron condor trade on RUT this week. The other thing about the SICP is when you harvest a profit, it's a chance to reevaluate the chart for any change in the directional bias. If there is a clear directional bias now where there was not the day before or earlier than that, then what you can do is you can adjust from a non-directional position to a directional position by harvesting a profit on one side and then closing the opposite spread where the price is moving against that spread. This action will adjust the position from non-directional to directional. And that really is what is so powerful about the credit spread strategy. It is a directional bias strategy that can be used as a non-directional. And when you really understand how to use the SICP aspect of iron condors, you can adjust back to a directional bias. So here we have the position that we opened. RUT had moved down just about 3 points to 1356, and we're still holding the 1385 call. That was the long call. But what we did is we took action and we bought to close the 1380 call for $1.36 of profit. So $1.36 of profit, and we were trading 3 contracts on this. So It's about $330 of profit. And simultaneously, when we bought to close that 1380 call, we sold to open the 1375 call to replace it. We're not interested in the way we use our trading strategy. We're not interested in just holding the long call. So we needed a replacement. So we replaced it with a 1375 call, and we sold to open the 1375 for a credit of $6.31. So now what we hold is a 1375, 1385 10-point credit spread with a credit of $1.49. So a credit of $1.49 after harvesting profits of $1.36 out of the trade. And we determined that in our point of view that the market has shown a stronger bias down than it does up. So what we did was we harvested a profit and held the calls, and we went ahead and closed the puts. Based on our chart pattern, the directional bias is down. We closed the put spread to get it out of the way. We took a 24-cent loss on closing the puts because we bought it back for $1.52, and originally we had $1.28 of credit. So now we no longer hold the puts, which means that we've adjusted from a non-directional bias to a directional bias position. And we hold $1.36 of profit already, and we're now queued up to potentially take an additional profit of part of this $1.49. We would never hold for the entire $1.49. When you're applying the SICP, the Seed Iron Condor profit approach, your first objective is to harvest a profit, which we did, $1.36, and then determine whether or not you want to adjust to a directional bias. Your second priority is to then take back your capital. So if the midpoint of the 1375, 1385 showed that I could close this position for, let's say, $1.40 to $1.50, I would do that, and then I would have all of my capital back. I might not make any additional money on it, but it locks in the $1.36 of profit that I've already taken. And then what I'm able to do is to take this capital and recycle it into a new position, a new opportunity, and do the same thing all over again. Now, if I had not seen a directional bias that had developed, what I might have instead done is widened the spread on the calls and taken that $1.36 of profit, and also widened the spread on the puts and taken an additional profit and continued to hold the Iron Condor. The SICP, when applied properly, can give you a tremendous amount of flexibility based on what you see in terms of directional bias. So the basic summary of the art of trading is, and as I said before, trade to learn first and then trade to earn, but focus on a single strategy. That is almost always going to improve your success. Whether it's credit spreads or not, I'm not saying that credit spreads is the only way for you to be successful. Not at all. You might have a particular strategy that you like, you really are comfortable with that. I would never encourage you to change what you're doing if it is working for you. But if you're looking for a place to start, credit spreads offer a great opportunity, as I said, to be very flexible in terms of directional and non-directional position. And then the advanced techniques such as an SICP offers that opportunity to harvest a profit and adjust. And our experience rate with the SICPs is that generally it improves your trading to a point where you're generating 20 to 25% profits on the capital that you have at risk in that SICP, that Iron Condor position. And we're pretty happy with that, and we teach this all the time. We use it almost every week in our Profit Builder program. So if you do find yourself in a situation where your position is in the money, where the price is encroached on your position, it's relatively easy also to manage a credit spread by simply rolling out or repositioning. I don't have time today to get into the specifics of rollouts and repositions, but they're very, very easy. They're very simple, and they're just a natural part of trading credit spreads. So basically, my summary of this and how to simplify your trading is to leverage cycles based on Bollinger Bands. Start by keeping your trading very, very simplistic. Bollinger Bands in terms of the charting aspect is a way to do that. It's a great approach for newer traders. It keeps things simple. It's also a great approach for people who may have gotten themselves into a state of being too complex and you're feeling a little overwhelmed. You can reset at any time and you can start over with a very simple approach. Build a forgiveness factor into each trade. That is the combination of being outside the Bollinger Bands when and if possible, and also having $1.20 to $1.80 of credit on your trade. It builds a forgiveness factor into each trade naturally, and this helps you perhaps be wrong or be premature on the entry of your trade, but potentially profitable as long as the price remains outside of your risk strike. And then always build time into your position in order to avoid that anxiety, that gut clenching roller coaster fear and anxiety, which is so often associated with trading because you're holding your breath, hoping and praying something's going to work out. You don't want to do that. You just want to use time to your advantage. We had a trade this week in our Profit Builder program, in our Profit Builder live account. We trade live account in our Profit Builder program. We had a trade that we were behind on for about a week, and we just kept looking at the charts. We were very patient. Yesterday with a big sell-off, it was a declining bias trade. We exited out of that trade. We were behind. If we'd closed it a week ago, we would have had a loss. Yesterday we closed it for a very nice profit overall. So part of it is just making sure you have enough time built into your trade. And I really do believe this is how simple things can be if you want to make your trading simple and be more profitable. So, this is the part where a lot of very, very good, intelligent people have such great programs and such great opportunity for traders to learn. There's so much great information out there, and sometimes it's hard to wade through it all. And this is the part where, I make you a really great offer. I don't want to make you an offer. I don't want you to pay me any money. I want you to learn. And I think that the most valuable way that you could possibly learn whether or not what we do would be beneficial for you, whether or not the way we instruct and the way we conduct ourselves and the way we help traders learn through their trading every day is to just observe and make a decision for yourself. I could tell you how great we are, and we are great. I could tell you how much money we make, and we do make a lot of money, and we help our clients make a lot of money. But I'd rather have you witness that. So what I'm offering you, if you're interested, is you can sign up free for a 2-week trial. And the link to sign up is optionsmoneymaker.com/PB free. So that's our Profit Builder program. In our Profit Builder program, what you're going to experience for a 2-week trial is we have a start of the market day live session, which lasts generally about a half hour, maybe 45 minutes. And we're going through some positions, generally SICP positions where we may have opened them, and we're looking to harvest profits. So you get to look over our shoulder. This is myself and my trading team, Aaron, Allison, and Michael. You get to look over our shoulder and in real time see us taking action. You get to see us execute the order. You get to see us discussing and thinking through whether or not now is the time to do it, how we decide when to take action, what the charts are showing us, all of that stuff. It's one thing to read a book, it's one thing to attend a seminar or a webinar, it's another thing to actually see everything in practical application in a live account. The account that we're trading these positions in is a live cash account. The money belongs to me personally, and I put it out there so that we can trade and show you exactly what we do. The other thing you'll experience is an end of day session, which opens an hour before the market closes. And in that session, we go through in detail every position that we hold, any positions that we may have opened during the day or closed during the day. We do a thorough chart evaluation, and we discuss each of the positions as to whether or not we want to take action, whether or not we think we should manage the position, adjust the position, roll it out, and what that would look like. It's basically you being able to see in real time everything that goes on and everything that contributes to making a decision for a successful trade. And each of those sessions are recorded, and during the 2-week trial, you will get recordings of those. So if you're not able to attend live, then you're going to be able to listen to the recordings at your leisure. Also, during the 2-week free trial, any trades that we open, close, or modify, any action we take in the Profit Builder account, we send out an alert. We send out an alert. We have a app so that the trade alert comes almost instantaneously to each of our subscribers, and you'll be able to follow along if you choose to. My recommendation would be, if you're not really familiar with what you're doing, is you follow along in a simulated paper trading account so you can just track our trades, but we send out those alerts. And then during the 2-week trial, you will be invited to attend one of our every other week Q&A sessions that we host for our entire community of traders. And there are questions that range from simplistic all the way to our very active, much more involved live trading room, which we host all day long, every market day. And you get to learn a lot, and it's free for all of our community of traders. So I hope you find that beneficial. I tried to give you some highlights of how valuable I think credit spreads can be, and how valuable it is to trade a strategy that you really are comfortable with and use it as the foundation for all of the trading that you do. Come and visit us in the Profit Builder program. We love to have people come in, ask questions, and our first priority is to trade, but we do try to take questions during the morning and afternoon sessions as much as we can, as much as we have time for. Come in and join us. And then after that, if you decide to sign up for our program, we have a ton of on-demand content, education content that will teach you all the details. In the 2-week trial, you're just going to observe, and you're going to hear us talk about some things you may not fully understand. And that's fair. We understand that. If you end up participating as a full Profit Builder client, then you get all of the education content when you sign up. So that's it for me. I hope this was beneficial. And again, thank you so much for spending a portion of your day with me. Best of wishes to all of you on your trading. I really do believe trading is one of the most exciting things people can do, and one of the best opportunities to learn.